If I had to choose one sentence that has cost ordinary investors more money than almost any other, it would be this one. This time it is different. That sentence shows up every few years wearing a new uniform. Sometimes it arrives in a recession, sometimes it arrives in a banking panic, sometimes it arrives through inflation, sometimes it arrives through politics, and sometimes it arrives through war with oil spiking, headlines multiplying, and nervous people suddenly deciding that the basic rules of long-term investing no longer apply. I have spent too much of my life watching intelligent people lose perfectly good money because they were seduced by that sentence at exactly the wrong moment. So let me tell you what I believe is actually happening right now. We are not living through the end of the market. We are living through one of those periods when volatility gets mistaken for permanent damage. And periods like that, handled properly, can become some of the best wealth building windows you will ever see. Not because chaos is fun, not because uncertainty disappears, not because buying the dip is some magic chant that turns every red candle into free money, but because broad ownership of productive assets has a habit of rewarding discipline precisely when emotional people are busiest explaining why discipline no longer works. That is the whole game. And it is a lot easier to see once you stop treating every crisis like a prophecy and start treating it like a test of process. Right now, a lot of people are looking at the war, the oil market, the inflation chatter, and the daily confusion coming out of politics, and concluding that the market must now be uninvestable. That is the natural emotional conclusion. It is also usually the expensive one. Markets hate uncertainty in the short term. That part is true when the world becomes harder to price. The market throws a fit. It sells first, reprices risk, and asks questions while everyone else is still screaming into the television. But that is not the same thing as saying long-term wealth creation has stopped. A broad market is not a mood. It is not a press conference. It is not a social media argument. It is not a fearful chart watched by people who were never going to hold 10 years anyway. A broad market is a collection of businesses. Those businesses continue selling software, oil, toothpaste, semiconductors, insurance, cloud services, hamburgers, medicine, logistics, and industrial equipment, whether or not the public has temporarily decided the world is ending. That is why I have always told people to begin with history instead of adrenaline. History does not tell you the exact day to buy. It tells you what kind of behavior has been repeatedly rewarded and what kind of behavior repeatedly ruins people who should have known better. And history says something very simple in periods like this. War often creates an ugly opening act. After that, it creates opportunity. I do not say that emotionally. I say it structurally. When geopolitical conflict erupts, markets usually sell off because uncertainty rises. Investors do what investors have always done when the future gets harder to model. They demand a bigger discount. That is all a drawdown is in moments like this. The same future or roughly the same future being sold at a lower price. Because the path between here and there now looks messier. That matters. Because if you are a trader, mess is a threat. If you are a long-term owner, mess can be a gift. The problem is that most people want to own like investors. When things are calm and react like traders when things get volatile, that is the contradiction that destroys them. They want 10-year returns with 10-day nerves. That combination does not work. If you're going to own broad American business, then you have to accept something that sounds boring but is absolutely decisive. The path is never clean. The returns are earned through discomfort. The market does not hand you 8%, 10%, or 12% a year in a neat envelope. It hands you years of noise, stretches of doubt, ugly corrections, temporary repricings, and then, if you were patient enough to remain an owner, it hands you the result afterward. Everybody loves the result. Very few people love the path. That is why wealth stays concentrated in the hands of people who can tolerate emotional ugliness longer than average. Now let me get specific because I do not want to confuse conviction with carelessness. Could the market go lower from here? Of course it could. That is not only possible in an environment like this, it is normal. In fact, one of the biggest mistakes I see is people taking a long-term bullish setup and implementing it with short-term certainty. They hear a strong argument for future returns and immediately want to convert it into one giant lump sum decision. They want one dramatic act that proves they were right. That is ego, not investing. A sensible investor prepares for a range of paths. He understands that the first month of a war can be ugly. He understands that the following 12 months can remain highly volatile. He understands that fresh highs do not guarantee smooth sailing and fresh lows do not guarantee the final bottom. He also understands something far more important than any of that. Volatility is not the enemy if you know what you want to own and you still have capital to deploy. That is why the opportunity is not in being clairvoyant, it is in being ready. And readiness in markets is usually much more valuable than prediction. A lot of people think successful investors are great forecasters. Most are simply better prepared than the crowd for what uncertainty looks like in practice. They know in advance what they want to own. They know how much they are willing to buy at different levels. They know how much cash they need for life and how much cash is merely fear dressed up as prudence. They know that buying in stages beats betting their dignity on one perfect entry. And they know that if markets overshoot to the downside, they want to be one of the few people emotionally and financially capable of buying more, instead of joining the panic. That is not sexy. It is extremely effective. Now let us talk about the long game, because this is where people consistently lose perspective. Bull markets have historically lasted longer than bear markets. They have also delivered much larger cumulative upside than bear markets have delivered cumulative downside. That is not optimism speaking. That is arithmetic. If you reduce investing to very short horizons, then yes, you are playing a dangerous game, day to day, week to week, month to month. The market can make any fool look smart and any smart man look foolish, but stretch the horizon, move out to years, move out to a decade. Now the game changes completely. Most 10-year periods in the market have been positive. That is one of the most important truths in finance. And it is ignored constantly because it is not dramatic enough for people who make money selling urgency. Everybody wants to know what happens by Friday. Almost nobody wants to hear that the richest probabilities live in the next 10 years, but that is where they live. And that matters right now because the market is once again offering one of those setups where patient people may get paid for other people's impatience. That is the real opportunity. Not this week, not this candle, not this television segment, the next decade. If you begin there, everything gets clearer. You stop asking, can I perfectly time the next 3% move? You start asking, am I buying a productive asset at a valuation and in an environment where 10-year returns are likely to be favorable? That is the adult question. It is also the one that builds fortunes. Now I want to deal with the oil panic directly because people always overlearn from whatever is currently in the headlines. Oil spikes and suddenly everyone decides that inflation is permanently unanchored, that recession is inevitable, that the 1970s are back, and that equities must now be treated like toxic waste until further notice. That is narrative intoxication. Oil matters. I am not foolish enough to say otherwise. Energy feeds into transportation, manufacturing, logistics, consumer prices, and sentiment. But a commodity spike is not the same thing as a permanent inflationary regime. First, high prices create their own cure. If oil goes high enough, demand gets hit. Consumers change behavior, businesses pull back, marginal buyers disappear. The system adapts. Emergency prices are rarely stable prices. Second, not every price surge should be mistaken for durable inflation. Inflation in the persistent sense requires more than just one input rising. It requires the monetary and fiscal backdrop to keep validating higher nominal prices over time. And third, markets usually price the fear before the broader public has even organized a complete sentence around it. That is why I care less about whether the story sounds frightening and more about whether the fear has already produced better entry conditions. A lot of investors still do not understand this point. A market can be the same price it was months ago and still be much cheaper underneath. If earnings expectations improved, if forward multiples compressed, if sentiment got cleansed, then the same index level can represent a much better bargain. Price is what people stare at, valuation is what adults pay for, and right now, that distinction matters. If the broad market is trading at a meaningfully lower forward valuation than it was when everyone felt safer, then the market has actually become more attractive for the long-term investor, even if the number on the screen looks familiar. That is one of the oldest tricks fear pulls on people. It convinces them that because the chart is noisy, the bargain must be worse. Sometimes the bargain is better. That is exactly why panic periods can be so lucrative for people with a process. Now let me give you the process I actually trust. I believe in dollar cost averaging for broad market exposure because it forces humility into the system. You do not need to know the exact bottom. You do not need to know whether the market is down another 8% next month. You do not need to know what some politician will say tomorrow morning. You simply keep buying. If the market rises from here, good, you participated. If the market falls from here, also good. Your next dollars buy more. People mock this because it sounds too simple. Simplicity is one of the great advantages in finance if you can tolerate how unglamorous it feels. But there is a more powerful version of it if you are thoughtful enough to execute it properly. Keep your normal buying schedule? Yes, but do not leave yourself so fully deployed that a major drawdown becomes emotionally interesting and financially useless. If all your money is already committed, then the next dip may make you intellectually excited and practically impotent. That is a bad combination. The great fortunes in volatility are not made merely by being optimistic. They are made by being funded. You must have some capacity to buy more when the opportunity becomes extraordinary. That does not mean hoarding cash forever. That is another trap. Cash is useful if it is a tool. It becomes expensive when it is an identity. Too many people tell themselves they are being prudent while sitting on enormous cash positions year after year waiting for the crash that justifies their caution. In that time, the market compounds, businesses grow, inflation eats purchasing power, and the cautious person slowly underperforms his own intentions. So I am not arguing for maximum cash. I am arguing for strategic cash, enough to let you exploit fear, not so much that fear exploits you. There is a world of difference between the two. Now, I want to say something about broad market ETFs versus individual stocks, because people confuse these games constantly. If you buy the broad market through an index fund, the structure itself does part of the work for you. Weak companies lose relevance, stronger ones replace them. You get the auto-correcting quality of capitalism. It is one of the most forgiving tools ordinary investors have ever been given. That is why I think broad market ownership remains the default answer for most people, especially in volatile periods. The fund handles the garbage disposal. Your job is simply to keep owning. Individual stocks are another matter. If you want to use volatility to create genuinely outsized wealth through individual names, then you need two things most people do not have at the same time. You need to pick truly exceptional businesses, and you need the discipline and conviction to hold them through periods that will make average people physically uncomfortable. A great stock can still fall 50%, 60%, even 70% in a bad cycle or in a temporary repricing. If your conviction comes from somebody else's newsletter, somebody else's excitement, or somebody else's confidence, you will fold when the drawdown arrives. That is why broad market investing is so superior for the majority of people. It removes the need for heroism. It lets you participate in capitalism without constantly testing your nervous system. If you do choose to own individual businesses, then do not fool yourself. You are entering a different game. You need research. You need a reason for ownership that survives ugliness. You need to know what makes the business durable, not just exciting, and you need to be psychologically capable of seeing a great company trade like a bad idea for long enough that your edge actually has time to work. Most people do not want that. They want the upside of conviction without the pain of earning it. The market never offers that deal. Now, let's talk about profit taking, because the crowd also gets this wrong in both directions. When markets get chaotic, some people decide they should sell everything. That is stupidity. When a position becomes enormous after a huge run, other people refuse to trim even a little because they think trimming means they doubt the thesis. That is also stupidity. Risk management is not betrayal. If you have a position up 100%, 150%, 200%, and it has become too large relative to the rest of your life, taking a little off the table is just sensible behavior. Not because war exists, not because the sky is falling, simply because concentration risk increases the cost of being wrong. That is what mature investors understand. They do not liquidate because of fear. They rebalance because of asymmetry. The distinction matters. Selling everything because you think you can perfectly time a geopolitical event is fantasy. Trimming an oversized winner because one position no longer deserves that much power over your future is prudence. Again, structure beats emotion. That phrase explains almost everything. Now, I want to say something that may irritate a few people but needs to be said. The United States remains the deepest and most trusted capital market in the world. In moments of global stress, capital still tends to run toward the dollar and toward U.S. financial assets because, in a bad neighborhood, the best house still matters. People love to predict the end of that reality. They do it every few years. Maybe one day the monetary order changes meaningfully. Maybe one day a credible alternative emerges. But I do not run my portfolio based on stories that have been premature for longer than many investors have been alive. I run it based on what the system actually does in moments of stress. And in moments of stress, American financial assets still occupy privileged territory. That does not mean blind nationalism as an investment strategy. It means realism. If global capital keeps choosing American depth and American liquidity in emergencies, then broadest market ownership remains one of the strongest default positions a long-term investor can have. So where does that leave us right now? It leaves us in a familiar place disguised as an exceptional one. Fear is high, volatility is real. The path over the next year could be sloppy, jagged, and deeply irritating. Oil could spike again, the market could roll over again, people could panic again, and all of that can coexist with the possibility that the next 10 years still reward disciplined ownership very generously from here. Those statements do not contradict each other. The problem is that most people still want the market to tell them one simple emotional story. Either everything is safe or everything is dangerous. Either buy everything or sell everything. Either certainty or surrender. Markets do not work like that. Adult investing is about handling mixed conditions without losing the plot. Here is the plot. The broad market has historically gone higher over time. Crises have repeatedly created buying opportunities for long-term owners. The most money has not been made by those who perfectly timed bottoms, but by those who stayed in the arena and kept buying when everybody else was nauseous. Temporary fear can improve long-term entry conditions. Buying in stages beats trying to be a hero. Strategic dry powder is useful. Permanent paralysis is costly. And if you want to own individual stocks in this environment, you must bring both business quality and emotional stamina. That is it. Nothing mystical, nothing glamorous, nothing particularly new, which is exactly why it works. The crowd is always looking for novelty. Wealth is often built by doing the old things correctly, while other people chase new explanations for why the old things have stopped working. I have seen too many crises to believe that line anymore. What usually changes is not the long-term logic of ownership. What changes is the price at which fear briefly lets you buy it. That is why I think this kind of environment can still become one of the great wealth. Building windows for disciplined people, not because every day from here will be easy, not because every dip will be the final dip, not because every stock will recover, but because chaos has a way of handing bargains to people who still know what they are looking at. If you are the sort of person who needs applause, wait for certainty. It will come when prices are higher and opportunities are worse. If you are the sort of person who wants long-term wealth, accept uncertainty as the cost of admission and start acting like an owner. Buy broad, buy patiently, keep reserves, add on fear, and stop asking the market to make you comfortable before you agree to participate. Comfort is not where the money is, preparation is where the money is. That is the lesson. The market may shake for months, it may irritate you, it may test you, it may offer several more ugly headlines and several more dramatic dips before this chapter is over. Fine, let it. If you know what game you are playing, those things are not reasons to run. They are reasons to stay disciplined while the world gets sloppy. And if you do that long enough, you will discover what every great long-term investor eventually discovers: the moments that feel the least safe are often the moments that most improve your future returns. Provided, of course, that you still have the courage to keep acting like the future belongs to owners instead of spectators. It usually does. One final thought before I leave you with this. A lot of people believe wealth is built by making one brilliant call at the perfect time. I have almost never seen it happen that way in real life. Wealth is more often built by refusing to make one stupid decision at the wrong time, refusing to panic out of a good asset, refusing to wait forever for a cleaner entry that never comes, refusing to confuse volatility with permanent destruction, refusing to let the news rent space in your head at the exact moment your process was supposed to protect you from yourself. That is why I still trust patient buying more than dramatic forecasting. Forecasting flatters the ego, process protects the capital. And when this stretch is over, when the headlines are quieter and the charts look safer and everyone suddenly claims they knew all along that the dip was a gift, remember this moment. Remember how ugly it felt while it was happening. Remember that the opportunity existed not after the fear was resolved, but while the fear was still loud. That is where the advantage always lives for the investor willing to act a little more rationally than the crowd.